Very good morning, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to Price Action versus Order Flow. Now, this is more of a preview webinar where we're going to discuss more about price action versus order flow. Like some of the very basics is what we're going to discuss in today's session. So, a little bit about me. My name is Rajendran. I'm the founder of Market Calls and creator of OpenAlgo. So, I've been practicing order flow for more than a decade now. I started order flow analysis during 2012, and I've been till to date I've been using order flow almost 12 plus years. I've been using order flow so far. Now, what you can expect in this session is like some very basic insights how an institutional order flow happens, and understanding the supply and demand levels. So there are some basic techniques in price action. So using that, we'll be trying to identify the basic supply and demand levels. And of course, we'll be comparing how the price action trading is more relevant to the order flow and what are the key difference between price action trading versus order flow and key patterns in the market structure and of course the market participants. Now, this is what we're going to learn in today's session. It's going to be a two-part series. This is a two-part series we are doing as a primer before to our upcoming session, Masterclass on order flow. All right, let's quickly get into the session. Just give me a quick confirmation about the audio and video quality. Is the audio and video quality is good enough? If yes, simply type yes so that we can quickly kickstart with the session. All right, great. Joshua says yes. Nikhil says yes. Nagarajan says yes. Vinod says yes. Prabhat Mittal says yes. I think Vaibhav says yes. Dharmarajan says yes. Gajendra says yes. Kamalakannan says yes. All right, great. So if in case if you are using browser other than Chrome or Firefox, it's highly recommended that you use the Chrome and Firefox. And it's highly recommended that you consider using the desktop for accessing this because a lot of minute details will be discussing. So it will be highly recommended that you use the desktop instead of if you've been connecting from the mobile, it's highly recommended that you use from the desktop. So let's try to understand some of the basic trading technologies used to transmit orders. Right, we retail traders, we use IBT terminals. IBT means internet-based trading terminals, the web-based trading terminal, or some people will be using mobile terminals to place orders. But when it comes to broker sending the orders, or even sometimes prop trading sending the orders, or even some institutions, they'll be using CTCL terminals. So usually CTCL terminals are offered to dealers, right? So it's computer to computer link based terminals. They'll be having a direct lease line with the exchange, and placing the order will be at a very faster route when it comes to CTCL. And there is also another route where institutions send their orders, DMA. So particularly DMA means direct market access. DMA is right now available only to the institutions only. Institutions like foreign portfolio investors, or maybe local mutual funds, or domestic insurance funds, right? Those funds, if they want to send large quantities of orders in a very algorithmic way, right? So there are a lot of algorithms out there. We'll be talking about that. Now, I'm not talking about the buy-sell algorithm. These are like execution algorithms. So they'll be mostly using the DMA route. And then there is another route called Colo. Colo is mostly called as co-location, mostly used by HFT traders. Again, some institutions, they do use for various purpose. Mostly for when it comes to Indian market, most of the co-location is done by arbitrage players, right? So how the institutions place their orders, they don't use the normal IBT orders. So what is the difference between IBT, CTCL and DMA and Colo is, let me try to give an example. I'm going to give a pictorial diagram about how the retail orders got routed and how the institutional orders got routed, so that you'll get a basic idea how the thing works in the market. This is very important. So let me try to pull up a whiteboard here, Microsoft whiteboard. Let's say I'm a retail trader. If I am placing my orders, usually it will be transmitted in a very slowest route. So the route goes like this. So basically, if I am placing my order, I'll be logging into my broker web terminal or maybe EXE terminal. I'll be entering my login credentials, passwords, and everything, and then I'll be submitting my order, right? When I submitting my order will goes to the broker server. The order will go to the broker server. So let's say I'll put this broker server a bigger one. So inside the broker server, there are a lot of checks will be done. There'll be some RMS checks will be there. There'll be RMS. So let's call this as an IBT terminal. IBT terminal. So where this is more of a retail order. So this RMS is nothing but an risk management system. RMS means risk management system. Now this is the one which will be responsible to check, do you have access to the exchanges, or do you have a valid sufficient money is there? Can I allow market orders? Can I allow stop loss orders to this particular? Let's say if you are placing an option trade to the broker, you are submitting an stop loss market order, then broker will reject it. How? Because broker have an risk management system saying that if it is an option order, don't allow stop loss market order. You know, right? Stop loss market order has been banned by the exchange. So the RMS will detect and ensure that you are having a valid margins. Only if there is a valid margins are there, sufficient funds are there in the account, and it will be looking into other factors, then only your valid order will be approved to send to the OMS. So there is something called OMS. OMS is the one which will be responsible for transmitting your orders. OMS means order management system. So from the IBT terminal, it goes to the OMS of the broker server. Now this OMS is the one which will be having connectivity with multiple exchanges. Let's say it could be NSE, or it could be BSE, or it could be MCX. I would say like this route is kind of a slowest route. Maybe if I am transmitting my order from IBT terminal to the broker server, from the broker server to the exchange server, typically it will take anywhere between 100 millisecond to 1 second. That is the kind of a route that we are talking about over here. Right? This is from a retail order perspective. Maybe CTCL terminal will be functioning like this. So CTCL, who use the CTCL, normally the CTCL terminal is used by brokers. It's also called as a dealer terminal. Right? It's also called as a dealer terminal. Or it will be used by sub-brokers mostly. When it comes to Indian market, I'm talking mostly from an Indian context only. Or the CTCL terminal will be even used by prop traders. And not only the prop traders, even some of the institutions also, they do use domestic mutual funds. Domestic mutual funds or maybe pension funds. So mostly domestic funds, they'll be using this route. This is kind of a direct connectivity with the exchange, kind of a little bit of a faster route because it doesn't go through the regular internet. So let's say I'm having an CTCL terminal. CTCL. The CTCL will be directly connected through a lease line. kind of a fastest route directly through the exchange. So definitely it'll be like the fastest. And then next comes the direct market access. I'm not going to go very detailed or very technical into the details. I'm just giving a high level overview over here. So next comes the direct market access. So DMA. So talking about DMA again, the DMA access. Who uses the DMA access? If you ask me, mostly foreign portfolio investors or FIIs and domestic institutions, DIIs. They are the one mostly uses DMA access. Now, when it comes to DMA access, even the DMA access, the connectivity is straightforward. That will be allowing you to connect without any RMS. They'll be able to directly able to transmit orders to the exchange, bypassing the brokers. There is no broker is required in no intermediate broker is required over here. So DMA will be able to connect directly to the exchange. And then finally, we have co-location. So co-location, who uses colo? Colo is mostly used by the high frequency traders, HFT players. So HFT players can be a prop trader. So HFT traders can be a prop traders, or even it could be even institutions also. When it comes to Indian market, I don't think mutual funds are allowed to do HFTs. So only prop traders are the one mostly dominated in this space in the co-location area. So when it comes to co-location, the server itself, the entire trading system server itself placed inside, very close to the exchange, right? So probably very, very close to the exchange, or it will be kept inside the exchange itself, first of all. Anyways, we're not going to cover deeper into colo over here. So these are the ways various orders are routed by various market participants. Now coming back to the topic, right? So these are the ways orders has been sent. But there are a difference between how an institutions they send their orders versus how a retail send their orders. Now, when institutions are sending their orders, right, typically a very large chunk of orders is what it will be sent, right? So if I'm in a mutual fund, usually I'll be getting money on my day-to-day basis from the clients. It could be a SIP money, or maybe it could be an clients parking in some certain mutual funds. On a daily basis, there'll be inflow of money will be keep on coming in. So as a mutual fund manager, they have to arrange trades on a daily basis. So daily basis, their dealers will be having a daily task. They have to prepare for their trades. So they have to buy a large chunk of trades on a day-to-day basis. So, right, if you see the FIDA activity, you'll be seeing some every day, there'll be some big numbers will be there. So FI bought so and so crore, DI bought so and so crore. Every other day, crores of transaction has been done on this, right? So their order size is typically very high. So since their order size is typically very high, they cannot send a one single order like how we retail traders do. Let's say I want to buy 5 lots of Nifty. What I'll do, I'll go and open my trading terminal. I'll punch 5 lots of Nifty and I'll transmit my order. That's it. So I'll click one button and then the order will get submitted. But the same way institutions cannot operate. Now, what institution has to do, they have to split their orders into multiple chunks, small packets. Let's say the quantity to fill is like 1 lakh quantity. 1 lakh quantity, they cannot dump in one shot. If they're going to dump it, right, so that is going to ruin the markets. Of course, they also have a lot of complaints. Just like that, they cannot dump a huge block of shares. They cannot, just like that, they cannot simply go and dump in the markets, right? So what they will do, they will cut down the larger order size into smaller pieces and they will try to execute it mostly without impacting the markets heavily. So they'll be mostly using advanced trading technologies like DMA, CTCL kind of technologies, or some very few institutions, they go for co-location. And mostly they demand a high execution speed. So something like direct market access, usually the response will be like in a couple of milliseconds. And co-location, they'll be talking about microseconds. That's a kind of speed. So co-location is the fastest. Compared to that, DMA is a little bit faster, and then CTCL, and finally the IBT. IBT is more of the slowest route compared to all the other technologies. So when it comes to retail traders, right? So basically, these are like small size of orders. Compared to institutions, it is relatively small sizes, and primarily provided by the brokers. Almost wherever you go, you have to connect through. If you want to submit orders, you have to submit orders only through the brokers only, of moderate speed. And when it comes to institutional orders, which orders they use, whether they use limit orders or whether they use market orders, this is a primary question that I'm sure you might be having in your mind. See, most of the time, institutions, they use limit orders because it has a great advantage. We'll talk about that. But they also use market orders also. But not in every case, only when there is a need is there. When speed is priority, right? When investors, institutional investors, they generally go for market orders only if they are having an priority to execute. Let's say suddenly there is an event announcement is coming in. Now, back then, if you remember, right? So the corporate tax cut happened back around 2019. All of a sudden, mid of the day, around 11 o'clock, I think, right? So our finance minister Nirmala Sitharaman is coming and announcing that we are reducing the corporate tax cut. Now, suddenly, what happened? There has been a sudden intraday shoot of like 700 points in Nifty with a huge volume. Why? Because suddenly there is a urgency from the institutional investors that something drastically, some news has been floated. So there will be sense of urgency is there. When there is a sense of urgency is there, institutions do use the market orders. But do they use on day-to-day basis? If you ask me, absolutely no. They don't use the market orders on a daily basis because that will be heavily impacting the markets. Maybe let's say if there is a war tension is there, that happened, right? So when the Russian-Ukraine war tension happened, even recently also Israel-Iran tension is going on. So what you will be seeing in the market is like the volume flow would have been very much higher. Huge volume flow, huge chunk of volume you can see on a day-to-day transactions around that time only. But a regular market, a reasonable market flow, not much of a big volatility. What you'll be finding is like slow and steady markets, calm markets. Now, those are the places institutions would like to accumulate or maybe even reaccumulate or distribute using the limit orders. So where that point of time, they don't have any sense of urgency. They don't need speed of execution. For what more is important there is like they need a better execution price. So they need a low cost execution. They know that if they're going to use market orders, their cost will be high. So in order to reduce the cost, in order to make the fair transactions, what they will do, they will be mostly using the limit orders for accumulation and distribution purpose. So we learned when institutions use limit orders, when institutions use market orders. But 80% of the retail traders, right, they do use market orders a lot. Because always most of the retail traders will be always in some sense of urgency. That is how the characteristic of the retail players itself. You can just type in the comment box what kind of orders that you will place. Do you place market orders or do you place limit orders? So that I'll get a fair idea. I'm sure most of the retail traders, they'll be mostly using market orders because they cannot control their, when they are looking into the markets, when they are looking into their technical analysis charts, so they cannot control their emotions most of the time. So most of the times they'll be using market orders, right? But somehow that has to go because market orders in a long term, if you're thinking about trading in long term, it is going to create a lot of cost. Maybe if you are, let's say you in a month itself, you're going to execute like 3 or 4 orders or 5 orders, then market orders make sense. But if you are a very frequent trader in the markets, let's say in a day itself, you'll be placing some 3, 4 orders, a minimum. I'm talking about that, right? In that case, maybe in the long run, if you go back and analyze the cost you are paying to the market will be very, very heavy, right? Kind of a huge cost will be paying to the markets most of the time. So that is why if you generally, if you look into the prop traders, they'll be mostly using the limit orders only, right? All right. So limit orders, what are the limit orders? So probably if you see this is the top 5 bid and ask levels that you are seeing in your broker terminal. Some brokers, they do even provide up to 20 levels also. This is a very old one, right? So I thought like I'll try to get some recent data, but Saturday, Sunday, I'm not able to get some better screenshots. So I have to use my old screenshot itself. This is Nifty 19 August futures. Back then, Nifty had a lot size of like 75. Now it is 50. Probably from next week on, from next month onwards, it is going to be like our next expiry onwards, it is going to be like 25. The lot size is coming down. So if you could see this depth of the market, what you are seeing is nothing but the pending limit orders. They are nothing but the limit orders. So you're seeing the top 5 bid and ask levels. So we are seeing a buy side over here. We are like buy limit orders on one side, and we are having a sell limit orders. Sell limit orders. Now, one good thing that you can see from NFO, Nifty Futures and Options. This is like a Nifty Futures and Options exchange, right? So here, all the quantities are always revealed. There is no concept of hidden orders. I was able to read in one of the Upstocks document that when it comes to Nifty futures and options, nobody can disclose. Everybody has to disclose all their orders, even if you are institutions. So even whatever the quantity that you are seeing over here, they are the true quantity. So whatever the volumes that you are seeing over here, they are the true volume. But that is not the case with equity markets. Equity markets, you may see some quantity, but in the behind, institutions can hide their orders. It's called hidden orders, right? You can also go back, you just go to your terminal. Let's say you want to place 100 quantity of Reliance, 100 quantity of Reliance that you want to place. Now, what you can do is like 10% you can hide it. Sorry, 10% you can show, whereas maximum up to 90% of the quantity, you can able to hide it. Right? So this is with NSE. Depends upon exchange to exchange, this number varies. I think MCX, you can hide up to 75% of the quantity, I think. Whereas when it comes to NFO, when it comes to Nifty futures and options, something like futures or even options, you have to reveal 100% of your trades. So that means you cannot place hidden orders. But in equity markets, an equity market like NSE or BSE, you can hide up to 90% of the orders when it comes to limit orders. So you have to understand one concept over here. These are nothing but limit orders only. Limit orders, they are nothing but pending orders. They don't move the markets. So what actually moves the market? The aggressive order. The market order is the one which moves the market. It moves the market. All right. So pending limit orders, they're just waiting for a fill. Now, some people, they will ask, so where are the stop loss orders? Or where are the stop loss market order? Where are the stop loss limit orders? Now, where these are? Of course, you're not going to see the stop loss orders over here. This is nothing but the order book. In the order book, you will find only limit orders. So where the stop loss orders will be sitting, exchange maintains a hidden book called stop loss book. So in the stop loss book, you'll be able to find the stop loss market orders and stop loss limit orders. Of course, it's completely hidden. Nobody can see anybody else stop loss. Even the institutions cannot see where your stop loss is. Even the high frequency traders also, they cannot see where the stop loss is because it is completely kept in a stop loss book. Exchange maintains two books. One is the order book where you place limit orders, and stop loss book, mostly for stop loss market order and stop loss limit orders. All right. All right, let's move a little here. So how these institutions, they'll be placing their orders, like particularly using the one, particularly the one who is using the DMA access, they will be using something called execution algorithms. So since their order size is very much bigger, right? So they may have to depend upon some algorithm. So one of the simple algorithm is called as a VWAP algorithm. I'm sure you might be heard about the VWAP indicator. So VWAP is the benchmark they'll be using to get a better price. Now, in a simple terms, how this VWAP works is like, if you see any stock or any index volume pattern, mostly morning volumes will be very high. And then mid of the day, what happens? The volumes will slow down. Maybe randomly there'll be some big volumes, but mostly you'll be seeing low volume activity. And when the market is about to close, at least in the last half an hour or last 45 minutes, you'll be seeing like again volume transactions will be increasing. So morning, this is like morning, volume flow will be very high when the market is starting. Always when the market starts, probably you would have noticed that big gap up, big gap down, the volume flow will be very high. Mid of the day, so this is like midday, volume flow will be low. So morning it will be like high, and even in the late afternoon or maybe in the evening hours, again around the market closing, again volume flow will be high. So when the volume flow is very high, what institutions will be sending? The institutions will be sending more orders, right? When mid of the day volume is very less, they'll be sending little transactions. They'll be making small transactions most of the times. Sometimes they will be making a big transaction. That is very rarely, but most of the times they will try to align with the volume pattern. And again, during the closing, their order, they know that the volume flow will be very high, so they will be making most of their trades around that level. That is how the VWAP usually works. So they will be aligned to the proportion of the historical volume patterns. That is how the institutions, they place their orders. If they are using the VWAP mechanism, right? Many institutions, they will be using the VWAP mechanism. TWAP, what they will do, they will time slice the order. So in a TWAP, I'm not going to explain everything over here, but a lot of mechanisms they'll be using. Some institutions, they'll be using market on close. Okay, when the market is about to close, what they will do, they will execute their transactions exactly around the market close or near to the market close. They'll be placing this market on close orders, MOC order. These orders we don't find in our retail terminals, but these orders they will be finding in the institutional trading terminals. They also have their own trading terminals, right? In their trading terminals, they can select these kind of orders, VWAP orders, TWAP orders. I think recently I seen in ICICI Direct website, right? In their trading terminal, they have these institutional orders. But nowadays, brokers started providing iceberg orders or hidden orders. This is what our retail brokers they started providing, where a larger orders are broken into smaller chunks. Sometimes even you can use hidden mechanism to avoid market visibility also. As I said, you can hide it in equity markets, even in currency markets, even in commodity markets, but it is not possible in NSE F&O. I don't know why they had hidden, why they had done this, but to be very frank, that is not possible. But still, you can implement an iceberg orders in equity markets typically. This is what institutions they do. Even this iceberg order mechanism is right now almost most of the brokers are offering. I seen this in Zerodha Terminal. I seen this in I think Upstocks recently had implemented this order slicing mechanism. Dun had that mechanism. Angel is having that mechanism. I think many popular brokers are implementing this mechanism. Off late, I mean, I'm seeing this trend in the last 2 years. Many brokers to invite active traders. So active traders mostly they want to trade with larger quantity beyond the freeze limit. So in order to promote active traders or in order to engage active traders, they are providing these kind of facilities because off late, right? When it comes to option trading, these are the most demanded facilities from the traders, particularly the active traders. But these are some of the very few executions is what I had provided. Otherwise, there are a lot of execution mechanisms are available, right? So, but these are some of the popular mechanisms which you can find in the institutional trading terminal. Now, what is the behavior of the institutional trading terminal? Institution is they do something called absorption. Let's try to understand the mechanism of absorption. So what I'm going to do is like I'm going to give you a fair idea how the absorption or what exactly an absorption is all about. Now, let's say when an institution is trying to, well, let's say when there is a market moves there. Now, sometimes what they will do is like institutions might find a high liquidity zone. So they will try to do more activity in a market order way. So they will try to, uh, so let's say this is like a rally and this is like consolidation. Consolidation. And again, there'll be a rally will be there, let's say. Let me mark this zone, this consolidation zone, because these are like very interesting zone from a market structure perspective. Now, typically, when these price actions are tested, right? So what you'll be finding is like a sharp reaction is what you'll be finding around these zones. Now, what happens is like these zones are the places the institutions will be sending in strong limit orders. So like kind of a market current, they'll be sending in flow of limit orders around these zones. Continuously, they'll be keep on targeting this area most of the times. Now, that is where it creates a zone called as a supply zone. Demand zone. I'm sorry. It's more of a demand zone. So, demand zone is nothing but a zone of support. It creates a support zone. So, what you'll be finding in this zone is like you'll be finding an absorption. So, the entire selling pressure would have been absorbed, and then the price will be able to move away from the zone very sharply without breaking the zone. Not only here, sometimes on the upside, the similar thing can happen. Let's say what can happen is like, let's say I'm having a rally here, followed by a rally, I'm seeing a consolidation. And this consolidation zone is very important. Followed by that, I'm seeing a drop in the structure. Now, this zone, what we can do, we can mark this zone as a very important zone. Now, usually when the price is getting into the zone, again, you can see some sort of an rejection. Sometimes multiple times it might be hitting, but usually the price will be defending those zones. Now, what again happens, institution will be sending a lot of pending orders. They'll be transmitting a lot of limit orders over here. See, limit orders will not make a price action, but they will control, they can defend the price action many a times. So that is how the institutions, they'll be defending their levels, right, around that consolidation zones mostly. So we are having a rally and we are having a consolidation. Rally, a consolidation, and then a drop. Right now, this zone is what we called as a supply zone. A supply zone is usually nothing but a simple resistance zone. A supply zone is nothing but a simple resistance zone. When it comes to price action, right, the supply zones and demand zones are nothing but an area of institutional interest. Institutional interest where institutions are expected, likely to behave. There's no guarantee that institution has to happen, but historically speaking, there are many places you can find at least some amount of difference will be coming around the supply zones or demand zones. So usually people will be using as a kind of a risk management location. Some people, they try to initiate trades around the supply zones or demand zones. But let me tell you, these are like very basic things. They're not, I'm not trying to explain any trading rules over here. Right? So, but how do I know that really institutions are coming and trading around those levels? Now, that is where order flow comes in. Maybe later on I'll explain. First, we'll get through the basic principle of price action. Right? So, we learned about what is a demand zone. So demand zone is where we'll be seeing an absorption in the form of limit orders. A continuous limit orders will be sending. So who will be sending limit orders around those levels? The institutions. Maybe using the DMA access or maybe using the CTCL terminal. They will be creating such kind of limit order flow. Continuously, the flow of the order will be keep on coming into the markets to defend the price action. That's how they can do a difference, right? Whereas here also we're going to see an absorption. This is also nothing but in one form of an absorption only. Absorption, but it is happening on the top of the market. An absorption which is happening in the top of the markets. Now this zone is called as the supply zone over here. All right, now let's get back into some of the very basics of supply and demand zone. So here you can see that I had plotted the supply and demand zone over here based upon the market structure rules. Some of the very basic market structure rules is like the rally, base, and drop. Rally means sharp uptrend. Base means some sort of a consolidation. It can be a single candle consolidation. It can be a multi-candle consolidation also. And drop is relatively a very sharp drop in the markets. For example, in order to give a fair idea what is a rally, base, and drop, let's take a simple example over here. I'm going to try to draw a simple example here. So imagine I'm in it can be a daily candle, hourly candle, or any time frame, doesn't matter. Let's say I'm having a sharp uptrending candle. Now this candle we can attribute to rally. It's a rally. So followed by a small consolidation candle. We can call it as a base over here. Base. And then followed by that, this is like an uptrending candle. This is an uptrending candle. Followed by a drop. Let's say the market had dropped heavily. A big drop happened. Now, usually what we will be drawing is like the base is the one which is responsible for the zone. So here in this case, the zone will be like this. I'll be marking the candle high and low, and that becomes like a zone here. So what kind of zone it is? It is more of a supply zone. Supply zone. So we have a rally, we have a base, and then we have a drop. Now this is what we call as a rally base drop. So rally base drop, it creates a supply zone. A supply zone also gets created if I am seeing a drop base drop. Sometimes we might be seeing a different kind of structure. We call it as a drop base drop. Let's say the price already dropped. Yeah, already the price action is coming down. It's already a drop. Followed by that, I'm seeing a small consolidation candle. And followed by that, again, there is a drop. So here the color of the candle doesn't matter. It can be green, it can be red. So the base candle color doesn't matter at all. So followed by that, I'm seeing a drop over here. Now here also what we will be making, usually we will be making a reference around this zone. So this base zone. So this is going to act like a supply zone over here, right? It's going to act like a supply zone. So means an area of interest from the, maybe an area of interest from the institutions. Now, what can happen? Maybe if at all the price action is uh, coming down, if it is price is entering into this range, you can expect a lot of flow of limit orders around these levels. A flow of a limit orders around these levels. Maybe you can expect some sort of a strong resistance around those levels. Expected resistance. Right? That is what we usually identify from a drop base drop. Drop base drop. This is from a supply zone perspective. So we had seen an rally based drop, which is also called as RBD. RBD means rally based drop, or drop based drop. This is DBD. D, B, and D. D, B, and D. So Kumaran is saying like yesterday crude and MCX shows drop based drop. See, I'm sure you can find in across the time frame, you will be able to figure it out. Right? Sometimes what you will be seeing, uh, you will be seeing a hidden base. Something like, for example, there'll be a sharp up move. That's like a rally. It's an uptrending rally. It's a rally. Followed by a sharp drop. Sometimes you might be able to see this also. You don't see a base over here, right? So you'll be seeing a rally, followed by that, you'll be seeing a drop. A rally and a drop, which indicates that there is a hidden base is there. So kind of an hidden base is there. There is a base which is like hidden base. It's actually rally and drop only, but we have to understand that there is a hidden base is there. So that is how the rally and drop we need to consider. So even this also will be considered as a one form of a supply zone. So this is also where we'll be plotting a supply zone over here. So then followed by that, we'll try to discuss about institutional orders also. I mean, from the demand side. Something like drop base rally, DBR. So DBR, that is nothing but drop base rally. Let's say I'm having a drop. And then I'm having a base. Maybe the base might be looking like it could be one candle. As I said, it can be a couple of candles. Right? So let's say like this is how it is. And then I'm seeing a rally here. Rally should be like very sharp price action, completely moving away from the candles. It could be a very strong price action. You'll be able to see like price is moving the station very much faster. That is how we can identify the rallies. So here I'm seeing like 3 consolidation candles. So what I'll do, like I'll be drawing a zone of this 3 consolidation candle, and that zone is going to be my supply zone, I mean demand zone here, right? So this is a consolidation zone. This consolidation zone is what it is becoming like a demand zone. Demand zone is nothing but a support zone kind of. Demand zone is expected like only if the pending orders are expected over here. In a real life, will it be always happening like this? Not necessarily. What we'll be seeing is like sometimes you'll be seeing like the price action will be coming down. The expected thing is like expected to go down, but sometimes it can breach also. It can start keep moving higher, right? So in real life, but if you see the textbook style, they'll be seeing like a price exactly come to this zone and the price exactly moving away from this zone. But in real life, it will not happen like this, right? So, but these are like very basic things. So you cannot use this as a part of a strategy. Please understand that. But these are the very basics to get into the price action, to explore price action very much further. Right. So the anticipated thing here is like institutions will be placing their pending limit orders over here. That is what the anticipated thing. And generally, we have to understand an absorption is what is likely to happen around this zone. And this is more of a demand zone. Another form of demand zone can happen in a form of a rally-based rally, right? Usually, this is a very common phenomena, particularly when institutions are driving their price actions in search of liquidity. The rally-based rally do happen. So I'm having a rally, and then I'm having a small base. As I said, it can be a single candle or it can be a multiple candles. Let's say I'm just here for namesake. I'm just putting some 2 candles over here, and then a rally. Probably last Friday, you could have seen this kind of price action very much in Nifty. You could have been able to figure out this kind of price action. Now, this is the place we'll be having a zone of interest from the institutions in the form of a demand zone. So what are this? This is a rally. And then we have a base here. The base is nothing but the demand zone. And then followed by that, again, we are having a rally. So this is nothing but RBR. RBR. And like I said, here also we can have a hidden base, like a drop followed by a rally. If at all I'm seeing a big drop, say a big drop is what I'm seeing, followed by it's a kind of a downside move. Followed by that, I'm seeing a classical rally. It's like kind of an upside move. So this is like a drop and this is like a rally. So obviously we will be having a hidden base over here. So we'll be having some sort of an hidden base over here. So we'll be having some sort of a hidden base. Even that also will be considered as a simple mechanism. Maybe I'll show you in this is like Nifty, right? So here we are seeing a couple of consolidation followed by a sharp downside move. Followed by that, the price action is keep on coming down. It creates an first supply zone. Then later on, what happened? Price entering into the zone, a couple of times it touched. It's getting rejected. So means some sort of a resistance is happening around that level. And the price is getting dropped down. So later on, what is happening? Here you can see like there is a rally. Followed by the rally, there is an immediate drop is there. So I'm just marking that zone as a kind of an hidden base is there. So I'm just marking that as an another supply zone over here. Again, here you can see like there is a rally, a bunch of small consolidation zones followed by a big drop, right? So I'm marking that as well as a very important zone over here. And here, if you consider at the last Friday price action, at the opening, there has been a big drop over there. Even though there has been some freak ticks has been there, the candle has been seen as a big drop, right? So a big drop followed by small candles, a consolidation candles, and the consolidation range is getting broken out. And followed by that, we are seeing more and more, again, a rally. Again, you can see like small consolidation. Again, it is creating a simple zone is what we are able to see over here. Like there is a rally, there is a base. This base is a very important one. Followed by that, I'm seeing another rally over here. Right? A rally-based rally is what you'll be able to see on last Friday. Maybe I'll try to give a different color over here. Just simply mark a different color and then right extend. It becomes like a zone. It's basically a simple rectangular tool, right? So draw the rectangular tool and then do a right extend. Automatically, it becomes like a zone. Now, these are the zones of interest going forward. But well, it's also, so we already talked about rally-based rally, drop-based rally. These are like demand zones, kind of a support zones. And then we also discussed about the type of the supply zones as well, rally-based drop and the drop-based drop. We also discussed about hidden base also, right? But what is the real challenge if you ask me? We only have to assume that limit orders will be coming in, absorption will take place. As I said, in real life, an absorption may take place or may not take place. That's a problem here. That's a practical challenge over here. That is where the order flow comes in. Now, what the order flow shows is like order flow shows the trader's activity. Of course, it shows the market orders. The beauty here is like you can also understand the limit orders also. So first of all, we need to understand the basic of how the transaction happens. If I am sending an buy market order, how the transaction happens. Let me try to again explain the very basic concepts. As I said, today's topic is all about basic concepts only. So maybe I think we have a very limited time. Maybe another 10 minutes we'll focus over here. So imagine I am sending in Reliance. So I just want to buy Reliance shares. Reliance 100 shares is what I want to buy. I want to buy it immediately. So I'll send an market order. I'm sending a buy market order. If I am sending it to the exchange, obviously I have to go through the broker only if it's a retail order. When I am transmitting the order to the exchange what it does is like exchange will have the order book. Right? It will be having its order book table. This table will be having an limit orders. So we'll be having a buy side and then we'll have a sell side. So if I am sending a buy order, the exchange will connect with me with a top seller who is willing to sell at a reasonable rate, the top seller. Let's say the rate is like 2,800 or something like Reliance. So my transaction will be happening with a sell limit order. So a buy market order, a buy market order, a buy market order always does a transaction with a sell limit order. Now you might ask, how can a market order and market order, can they match? Of course, that is how the exchange is not designed. A market order always interacts with a limit order, right? A buy market order always interact with a sell limit order. Likewise, a sell market order always interact with the buy limit order. So the exchange here acts like a matchmaking between the market order and the limit order. It is like a kind of a marriage between market order and the limit order. That is what it is happening in the exchange. And the exchange does the order matching. That's what the job of the exchange itself. The exchange job is to do what? Match the buyers and sellers. Can a market order and market order, can they match against each other? Of course not. That is how the exchange is not designed. Right? Market order, you have a sense of urgency. So immediately you want it. And the opposite party will be filled by only the limit orders only. Even if it is an SL market order, right? Let's say even if you're placing an SL market order. SL market order. So what you'll be having? You'll be having a trigger price. When the trigger is reached, what will happen? This order will be transmitting to the exchange as a market order again. It's still an SL market order, also nothing but what? It is a market order only. But it will wait for a certain level to touch, and then the market order will be sent to the exchange, and that market order will interact again with the limit order only. So basically, there is only two orders only: market order, limit order. And of course, we also have a bracket order and cover order feature. That is also nothing but what? It's also designed based upon market orders and limit orders only at a fundamental level. At a fundamental level, there are only two orders: market order and limit orders. The stop loss order, stop loss market orders, cover order, bracket order, they are nothing but variants of market order and limit order. Right? So very simple. Market order moves the price, limit order, they control the velocity of the price actions. They cannot move the price. Limit order cannot move the price action, but they can control the velocity of the price action. So what order flow shows, let me show you the order flow here. I would like to talk about a very interesting context which happened on last Friday. Now, like how we have the supply and demand zone, here also we can have zones. So one of the zone I'll be mostly watching is the volume cluster zones. So here you can see only executed market orders, not the pending limit orders. You cannot see the pending limit orders from the order flow, but you can see only the executed transactions. So what does that means? Let's say I'm having an in the order flow, sell side will be on the left hand and buy side will be on the right hand side. So if I'm seeing like 6,021 lots are getting traded, this is like in terms of lot size, not in terms of number of shares. I divided the entire value by 50. So I'm just getting the value of lot size over here. So 6,021 by market orders, 6,021 by market order, which got interacted with the 6,021 sell limit orders, right? That is what it happened over here, right? So 6,021 is not, even though you are seeing on the buying side, somebody had made the transaction on the opposite side. Every buyer, there is an equal amount of seller. So we know who is the buyer is. Buyer is a market order and the seller is a limit order. That is how the transaction happened over here. And then once a transaction got confirmed, I'll be able to see exactly at that level in my order flow information. In my order flow charts, I'll be able to see this executed transactions. Of course, you cannot use order flows to see the pending transactions. But when the supply and demand zone is happening, you will be able to see how the transaction, how the difference is happening. Is there any absorption is happening that you can clearly see in your charts, or where the institutions are getting positioned. So here, if you ask me, if you see that big flow of volume, I can go and total the bid and ask. I can go for an delta shaded volume over here. So buyers and sellers put together, I'll be able to see the zones where the buyers and sellers are very much clustered. You can see that where the big volumes are happened over here. I just marked that as a two zones over here. So 873, 622, 2004, 1754. I'm showing you on a 5-minute charts. And then here 7,506, 2327, 1352, 451, 899, 1281. These are like two big blocks of volume happened on last Friday. You know what? The last Friday, what happened? There has been a news before the market starting. That time there has been a news has been circulated that Israel attacked the Iran. That is a news which got circulated. But later on, around 11 o'clock or 12 o'clock, they denied it, right? So Iran said nobody had attacked us. Probably it's some sound which has been created. So it's a false news. That is what Iran had given a conclusion. But when the market opened with a big gap down, the volume was like, look at the volumes over here. The opening volumes are extremely higher. Maybe if you have been watching volumes, right, you will know what kind of volume it is. Relatively, it's a very big volume. Definitely something like 22,000 lots if it is happening on a 5-minute candle, right? Usually it happens when there is a big gap down is happening because of some global tensions or some local news or some extreme bad news is happening. Because of that big gap down and big volumes, naturally some sort of a news-based tensions would have been there in the markets. But immediately what happened is like the next bar had broken the zone with a strong volume, with a strong delta. So maybe in the next week, we'll be explaining more in depth about each and every order flow blocks. I will try to explain it, how institutions plays a major role. In the next week, we'll be discussing about that. The same thing, the very next bar itself, there has been an a strong up move had triggered. That's where the immediate long itself got triggered. If in case if you are looking into the flow of the volume over here, there's an institutional zone. The institutional zone, this zone is what I'll call it as a volume cluster. Now, this volume cluster zone got broken up with a very big delta that usually triggers in a highly volatile markets, usually it triggers a long trading opportunity. So typically, I'll be anticipating something like 75 points of intraday move. Now, what also happened is like you see that price is entering into the zone, getting rejected. Not once, it enters into the zone, rejected, enter into the zone, rejected. Again, it was trying to enter into the zone, rejected. So again, it's been trying to enter into the zone, rejected. A lot of consolidation is what we are seeing over here. After the consolidation is where a breakout happened post that. Again, one more time, the price zone got tested one more time. We can see that the price is coming, entering into the zone. The zone, the defense has been provided multiple times around the zones. Right? Very important zone. Something like a kind of a supply zone, I would say, like the supply zone, the zone of interest from the institutions, which is a zone that you can clearly see it from the order flow charts, right? Very clearly you can see that the morning, there has been a significant area of interest from the big players, right? And then that zone got broken. The zone haven't broken down at all. That is how the difference has been made by the institutions. And later on, around 11 o'clock, we are getting the 11 o'clock or 12 o'clock. I'm not very sure, but that is the time the news got floated saying like there is no such negative news. Israel haven't attacked Iran. So after that market, right, there has been a strong rally happen later on. But morning, the defense, who had done the defense? The institutions had done the defense very clearly and evidently would have been able to see later on what happened later on, the rally started, right? So later on, we'll be able to see a kind of an, so these are the zones that you can see like very clearly, you can able to see like there has been a rally, 2 bars of consolidation, again a rally over here. So again, this is an area of interest. This is like rally based rally. Because here also I can mark a zone, double click on top of this rectangle, maybe change it to like the evening timing or maybe next day, apply, you will be getting a zone here automatically. Of course, this zone haven't tested at all. Again, there has been like a lot of consolidation followed by another rally is what it happened. A lot of huge consolidation. There's been a rally and then a deep consolidation. So this translates into another zone over here. So mark the entire high and entire low of the zone. That is how the zone happens. So there has been a rally. Followed by that, we are seeing some consolidations. And followed by that, again, we are seeing a rally. This zone is not broken out at all. And again, the price action keep going higher. Right. So throughout the day, the zone haven't got disturbed yet. One more time. So that is how the price action happened on last Friday. So Vaibhav is asking a very interesting question. His question is like, when we say market order moves markets, that means the price moves only when all limit orders are filled. Of course, when the transaction has happened, only then the price will be reflected on your screen. Maybe I'll try to give an example over here. So the simplest example I would like to give here is, I'll try to explain this again with a very interesting example. Let's say I'm having let's talk about Nifty itself. Let's say Nifty is trading around the last traded price. Let's say it is around 22,100. And let's say I'm sending an buy market order. I'm going to give a simple hypothetical example only so that it will be very easy to understand. So 10 lots is what I'm going to send. So when my order book is looking something like this, let's say my order book is looking like something like that. Let's say I'm having a bid and ask table. I'm having a bid and I'm having a ask. The bid is nothing but the buy limit order, and the ask is nothing but a sell limit order, right? So imagine I'm having like the buyers are willing to buy at lower prices, let's say 22095 or 22090 and 22080. Okay, so these are the three levels where buyers are interested in buying. Some top three buyers is what I have taken for simplicity. And ask side, let's say they are available at 22,105 and 22,110 and 22,115. Okay, maybe here there are two lots are there, and maybe here people had floated some 5 lots, and here maybe like some 10 lots are there. Likewise, maybe here also we'll call it like here there are like 1 lot, or maybe here like 7 lots, and here like 10 lots are there. So if I am sending in 10 lots of order, what will happen? This order will go and interact with the sell side. So the order will go on the sell side and it will try to interact, right? So it goes on the sell side and it will try to interact. So first it will try to consume these 2 lots, and then it will go and consume this 5 lots. So total 7 lots got over, right? So 2 plus 7 is 2 plus 5 is 7 lots. And from here, there are 10 lots are there. So here, what is my remaining requirement? Another 3 lots. So another 3 lots will get required, will got filled up. So 2 lots will get filled at 22,105, and another 2 lots will get filled at 2200, and another 3 lots, even though there are 10 lots are there, which is pending, the market order will take the liquidity of 3 lots. So total 10 lots. So what will happen? The price will instantly move from 2200 to the latest price of 22,115. So what is my last updated price now? 22,115. That becomes the last traded price. All right. So this is how the price action will happen. So you'll be seeing like suddenly there will be a price will be moving from 2200 to 22,115. Now, in real life, there'll be very tight orders. If you look into the order book in real time, you will see that probably like 5 paisa difference or 10 paisa difference. Sometimes even it could be like 50 paisa difference or 1 rupee difference. Here, for simplicity, I had given like 5 points difference. So to understand that how the market order, so who is actually moved the price action? The market orders. Just because I punch the market orders, I'm the one who is making the move in the price action. But what is the role of the limit orders over here? Absolutely nothing. Limit orders, they are not moving the markets at all. But maybe the limit orders can control the velocity of the price action. How? Let's say if the table over here, instead of having 2 lots, let's say there are 20 lots are there. Instead of 2 lots, assume that instead of 2 lots, let's say we are having 20 lots. Okay. Let's say we are having 20 lots instead. Now what will happen? I am punching only 10 lots. So I try to punch 10 lots over here. Already 20 lots is given over here. In that case, what will happen? My new price will not be 22,115. My new price will be 22,105 only. So here the price action is controlled by the limit orders. If the order book size is very thin, it is easy to penetrate, it is easy to manipulate also. But if the order book is very thick, very big flow of orders are always there, it is very difficult to manipulate, right? At least it is not easy to manipulate if the order book is thick. That's one of the reasons penny stock is easy to manipulate, because penny stock, right? You will not have much of a liquidity, not much of a limit orders will not be there in the penny stock. That's one of the reason many people say like mostly manipulators will be sitting there, because it is easy to manipulate. It is easy to make a quick price action. Anybody can go and make a quick price action in a penny stock. But that is not possible with Nifty, Reliance, ICICI, because these are the stock with big flow of orders all the time, because institutions will be always trading these orders. So it is difficult to manipulate Reliance or ICICI Bank or Infi on a daily basis. But penny stocks are not like that. Penny stock, if you go back and see, like, you will not find liquidity at all sometimes. You will not be able to find limit orders at all, or even if you're finding limit orders, mostly very thin limit orders only you'll be able to see that. Even if you're trading options also, you just go and see some stock options. What you'll be seeing is like uh, only very few trades would have been here and there, some very few prices only you'll be finding limit orders sitting over there. What does that mean? Those kind of stock options are kind of dangerous. That's one of the reason that you need to have some basic idea about how the liquidity is. Can I go and trade this or not? Where the liquidity is very higher, your cost is also will be very good. Maybe your trading decisions, you can apply your skill better. But instead, if you go and see, you want to buy some low liquid option trading instruments where liquidity is very low, then right, it's not a great way to deal with those kind of instruments. Better stay away from low liquid instruments. It's not for retail traders, at least. I guess this explains Vaibhav's question. If anybody is having any question about the basics about market order, limit order, you have any questions like do something else, somebody else is seeing my stop loss, if any sort of that kind of basic questions, you can always ask here. So Dharmarajan is having a question. After price moves up past a zone RBR, can the rally after base be a minimal move, forming a trap at the top and then form a drop? See, we are not going to anticipate whether rally base rally will form or rally base drop will form or not. We're not here to predict the zones. Once the zone is confirmed, we will be using that zone to check how the price action is responding to the zones. Right? So there are many times from a regular price action perspective, you can find that these zones plays a vital role of interest when it comes to the institutions. But here we are not here to predict whether today what zone will form. DBD will form, a drop-based drop will form, or rally-based rally will form, or drop-based drop will form or not. We're not here to predict the zones over here. When the price is coming to the zone or when the price is nearing the zone, how the price action is, or how the volume activities, or how the order flow information is. Now that is what it gives you more information about how you have to respond to your trades. So those are your trade locations most of the times. I guess that answers your question. All right, finally, a small promo over here. So if in case that you are really interested in learning more about order flow basics, we are coming up with an almost live masterclass session, right? Order flow analytics masterclass. We are starting from 4th May onwards, right? Followed by that, we will be having an morning sessions and afternoon sessions during the weekends. Followed by that, we'll be having 2 weeks of live training session every day morning, 1 hour we'll be spending. You'll be learning approximately some 16 trading strategies, and we'll also will be focusing about how the price action zones are more relevant to the order flow. So those sort of information you can anticipate, and more interesting strategies like volume cluster based strategies, stacked imbalance strategies, absorption based strategies, or price rejection setups, breakout failure setups. So a lot more trading strategies that you will be learning in this session. Particularly if you want to know how price action is more connected to the order flow, you can anticipate more from this course. And what are the different ways how we can we'll be able to spot a smart money, and how I can understand where the initiative drive is happening, where the absorption drive is happening, and you want to understand the basic principles of order flow based strategies. For those people, it's highly recommended, mostly for short-term traders and very short-term traders, mostly intraday traders and scalpers are the one who should be attending this session. And talking about the tools, you can come up with any order flow tools. There is no limitation to that. Generally, we recommend some Ninja Trader based order flow tools. If you're having a web-based tool also, it's well and good. All right. All right. So let me pause here. I'll say thank you for coming by and asking so many questions. So Vaibhav is having one more question over here. Vaibhav says, I mean the zones where limit orders are getting exhausted. So Vaibhav is saying like when market mover wants to gauge exhaustion of zone, what will be the indicators if failed auction is related to it? So failed auction is also one form of an exhaustion. Failed auction is more of a market profile concept. Failed auction is also one form of an exhaustion. There are ways in order flow also we'll be able to identify exhaustion. So it can happen in the form of an some sort of an exhaustion setups like a exhaustion candle with absorption or exhaustion with the inside bars. Or sometimes an exhaustion also happens with the low volume activity. Sometimes suddenly a rallying market slows down with the low volume activity and then the exhaustion happens. Despite that, the market will start falling down. Very easily, it will be very easy to spot from the order flow. Right? So does limit orders plays a major role in exhaustion? If you ask me, yes, many times limit orders also plays a major role when it comes to trend exhaustions. All right. So I say thank you for coming by and attending the session. Maybe the link here, I'll also share this order flow link as well. So later on, you can also, if in case we are planning to enroll, you can enroll in this session. So I once again say thank you for coming by and attending the session. See you in the next week, same time, 10:30 to 11:30. More interesting discussion about order flow and more interesting strategies also we will be talking in our next upcoming session. Don't miss it out. Thank you.